We have a question that Vimalesh has sent in, and he wants to know, Jayesh, what is the liability to pay capital gain tax for joint development agreements? I am not able to understand the announcement that was made in the budget on February the 1st. Can you explain in detail? This is, of course, a change that has come in, and this is something that landowners need to pay attention to. Jayesh?
Yes, Vimlesh, I believe you must be the landowner, because this amendment has been, I would say, brought for the benefit of the individuals and HUF who are owning the land. Up till now, I think there was a lot of controversy with regard to taxation of the joint development arrangement, whereby the landowner was, I would say, arguing that income is not taxable till he receives either the revenue share or he till receives the area share from the developer in terms of the joint development agreement or the arrangement. But the revenue authorities have been taking a position, depending on the factual aspects in the documentation, to say that the capital gain arises the day when the joint development agreement is entered into, and then the general power of attorney is being granted by the landowner. But now with this, I think this controversy has been set at rest by the finance minister to say that if you are an individual and HUF, and if you have entered into a joint development arrangement, and specifically it talks about the area share arrangement and not a revenue share. You might have some revenue share or some remuneration which is in the form of a cash, but largely it is an area share. And if you receive an area share after the project is complete, then your tax liability will get shifted from to the date of your receiving your share in the property. And what it says that when you receive your share of property from the developer, then the market or the stamp duty valuation of that property on the date of the receipt will be regarded as your sale consideration, and then you reduce your original cost of the land, so that will be your capital gain. And since you would have been holding for a period of more than 24 months, so that will be a long-term capital gains tax, and you can claim what you call it as a capital gains tax exemption of that. And when you receive that property and you sell that property, what it says that the stamp duty valuation which has been taken for considering capital gains taxation at that point in time becomes your cost when you sell your property, and accordingly the capital gain would need to be computed. And it also says that if the developer pays you some additional amount of money over and above the area share, then that also would be regarded, would be considered as a consideration. But then the developer will have to withhold tax at the rate of 10% when he's going to make the payment to you as a landowner. So this is again a good news. I think it is clarifying the position, and therefore there is a benefit. The law also says that if you have a share in that area share, and if you kind of exit before you want to receive your kind of property, in that case you will not be able to claim this benefit. You will be subjected to normal capital gains tax, so therefore this benefit will not be available.
Okay, I was just about to ask you.
When you exit in between, then there is no benefit.
What happens to this is of course for individuals, individual landowners.
Right.
We know that a lot of housing societies, especially in cities like Mumbai, are going in for redevelopment.
Right.
Some of them own the land, own the building, and they want their old building to be redeveloped, and they are also asking for a new tower to be built.
Right.
They might enter into joint development agreements.
Right.
Does this apply to the society as well?
See, the society is not an individual, nor a kind of what you call it as HUF. It is actually being regarded under the Income Tax Act as a body of individuals. So therefore, I suspect that this benefit would be available to body of individuals. But the arrangement that you're talking about for the society, there the tax consequences are a little bit different than what you call it as a pure transaction of the landowner entering into an agreement with what you call it as the developer. So the I would say the ramifications are a little bit different, and it can take about 15-20 minutes for me to explain.
Right. So essentially what you need to remember over here is that the law has changed as far as landowners are concerned who are going into joint development agreements. Capital gains, the exemption has to only be realized at the end when you actually get possession of the project, right?
Absolutely.
That in very simple terms, that's what it means. And as far as societies are concerned, the rules of course would differ, and like Jayesh said, it is a little complex and it does make a lot of sense, especially in light of all the changes that have been announced in the budget, to go to a tax consultant before you sign on those agreements with developers.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.